So last time I gave you a view of the financial clarity dashboard that I created for business owners to view their financial health in a snapshot. There are 6 key financial metrics that this dashboard is built on: profit margin, budget to income ratio, cash runway, payroll to income ratio, average weekly survival percentage, and debt service coverage ratio, otherwise known as DSCR. Today, I want to focus on DSCR. Underneath each of these metrics, there is a target. So any owner in here can tell where they need to be performing for each of these metrics. For DSCR, we want to be at 1.25 or greater. So I'm going to go down to my summary section to see how you get to the DSCR score. DSCR is calculated by operating cash divided by monthly debt payments. In other words, monthly cash profit before debt payments divided by your total monthly debt payments. In this case, $17,250 divided by 6,400 is going to give you 2.7. It's important to acknowledge that your monthly cash profit before debt payments and your total monthly debt payments are going to drive this number here. So that means if I increase my total debt payments or if I decrease my profit, it is going to affect what my DSCR score is. Let's go to the monthly inputs. So if I go to my total debt and loan payment, I see here I have 3 lines of credit, one at 1,700, one at 1,500, and the other at 3,200. Let's say I wanted to add another line of credit. Let's do credit cards first. Let's say I have a Visa credit card. I just have one Visa credit card. And I have to pay $125 minimum each month. And let's say I have a American Express. Also, $125 minimum each month. Let's see how that affected my DSCR score, which was 2.7 before. All right, we moved down to 2.59. Let's play a little bit more. Let's say I want to take out a fourth business line of credit. And let's say this was a really big one. So $2,500 a month is going to be the monthly payments. 1.89. We went down from 2.59 to 1.89. We're still above 1.25. So here I want to identify that if you're at 1.25 or greater, you have a lot more leverage and you could take on more debt and still pay easily and on time. We just added a monthly debt payment of $2,500 a month and 2 monthly payments minimum of $125 each for 2 credit cards, and we're still in black and white. Now let's play with it a little bit more. Again, the other driver of your DSCR score is going to be profit. So let's say one of our major clients, Houndstooth Fabrics, dropped out. Sorry, Maya, because this is Maya's marketing agency. Sorry, Maya, we are not continuing with our retainer. We're going to take them out. So I went from $55,300 a month. I'm getting that number from right down here in green. I went from $55,300 a month to $45,300 a month. So I'm lowering my profit, and I also got a new business line of credit and 2 credit cards. 0.79. Let's go back. Let's add back Houndstooth Fabrics. So Houndstooth Fabrics is a $10,000 retainer. So that means our income went down $10,000 a month. Before, our monthly cash profit before debt payments was $17,250, and our DSCR score was 1.89, with our total debt payments being at $9,150. So we're going to keep our debt payments at $9,150, but we're going to decrease our monthly retainer again by $10,000 because we're losing that client. Our DSCR score went down to 0.79. And then we're also at $17,250 right now. Our monthly cash profit before debt payments is at $7,250. If you divide $7,250 by 9,150, you will get 0.79. So right here, immediately the banks are going to see that you're below 1 and you are unable to fulfill any fulfill or pay back any monthly debt payments. Let's reverse back out and put that retain back in. So we see right here, 55,300 is a sweet spot. Let's say I want to get another line of credit. Let's just see what happens. See how much this business can handle at 55,300 a month. 1.48. My DSCR score is still 1.48. I'm still above that 1.25 mark that I want to be at to seem like an ideal borrower to lenders. So this is Maya's marketing agency. One thing that Maya can take away from this is that at monthly reoccurring income of 55,300, she is in a good spot. Monthly cash profit before debt payment, 17,250, is a great spot to be in because she could take on more debt. So here you see the higher you are above 1.25, the more stronger you look to lenders in your ability to pay back on monthly debt payments. One last thing I want to point out, notice that up here, our monthly recurring revenue is 55,300. Our total monthly recurring expenses are 49,700. That includes our monthly debt payments of 11,650. And our monthly profit is going to be 5,600. That's why I want to identify the key difference between our monthly profit of 5,600 and our monthly cash profit before debt payments. That means that this profit amount here does not accommodate for the debt payments that we're paying of 11,650. So if you add 5,600 to 11,650, you're going to get 17,250. And the reason why we don't include our true profit, we don't divide our true profit by total debt payments, because we are assessing how much cash do we have after we take care of everything that's an operating expense, not depreciation included, but everything that's just strictly an operating expense, things that we need to pay every month for the business to keep running. After we pay all those things, before we pay our debts, what is our profit? That is the 17,250 here in this case, or monthly cash profit before debt payments. We're going to divide that by the amount of our total debt and loan payments, which is $11,650, and that gives us a DSCR score of 1.48, which is well above our goal of 1.25 or greater. So please put it down in the comments. Do you know this information already? Was this a refresher for you? Is this fresh to your ears for the first time? Has no one ever gone over this with you? Were you not getting approved for loans and not sure why? This could be the reason. Your DSCR score is probably not in an ideal spot for lenders. So please put all your questions and comments down below. I will be happy to answer any questions that you have.